Hello dear students, this is the second chapter of financial management course. It is about financial performance analysis. As you may know, organizations need to know their performance over time. Just to know this, they should conduct kinds of analysis. So financial analysis is very much important. As you may know, financial statements are the output of the accounting system, but they are not enough by themselves. Therefore, we need to further analyze the financial figures, the financial position of a company, operating results of a given business, so that a complete understanding of whether that company is going well or whether it is in a devastating condition will be evaluated. So financial analysis is one among many tools useful in evaluating because it helps the financial analysts to measure returns and risks, and it is the art and science of translating the figures in the financial statement in such a way as to reveal the financial strengths and weakness and the causes of which are attributed thereto. So there are many tools that may be used to conduct analysis of financial statements, including common size financial statement, ratio analysis, DuPont analysis, and others also. When we go to the common size analysis, it is simply the method of analysis in which components of financial statements are compared with one another, especially with that of the benchmark. So in the financial statement, we have two major statements, the balance sheet and the income statement. So accordingly, we can have common size balance sheet, and as you may know, balance sheet consists of assets, liabilities, and owners or shareholders equity. So in the balance sheet, the benchmark is total asset or total liability and shareholders equity. So these values are given 100 and the others are components of this. So relative to this benchmark, each and every component will be evaluated. So let us refer to the common size balance sheet of Fine Corporation, which is a hypothetical example for the year 2018 and 2019. So accordingly, if you take a look at the total assets for each of the years, the 2 year, for instance, everything is evaluated relative to this total asset. If we start from 2018, the benchmark total asset is 100%. So every component of this balance sheet is relative to this figure, this percentage. For example, cash is 2% of the total asset in 2018 and 3.6% of the same. The marketable securities are 0%. No marketable security is registered or included in the balance sheet in 2018. But in 2019, 1.8% of total asset. Inventory was 8% in 2018 and now it is 5.5% in 2019 and so forth. So total current assets are 20% in 2018 and 27.3% in 2019, and in net plants and equipment is 70% in 2018 and 63.5% in 2019. So totally every component of the balance sheet item is compared against this benchmark. In the same way, the liabilities are compared against total liability and the total shareholders equity, which is considered as a benchmark. Therefore, from this, one can easily understand the trend of, the component of the balance sheet relative to the benchmark, which is total asset, for the year 2018 and 2020, 2018 and 2019. Then accordingly, one can easily understand the component of each in each year as well as in comparison with another year. So this is what we call common size balance sheet. The reason why we called common size balance sheet is every comparison is made among the balance sheet items. In the same way, we can also make analysis for the common size income statement. So income statement, as you may know, consists of both revenues and expenses. So every comparison is against the total revenue of a given firm in a given period of time. So if we take into account the same hypothetical example for the year 2018, here is 2018, it is missing, sorry, and this is 2019. So sales, which is total revenue, total sales is considered as a base or as a benchmark, so it is 100%. Therefore, cost of sale, or the cost that we incur in order to acquire the commodities and to be sold, is 66.7% in 2018 and 65% of the total sales in 2019. And in the same way, the difference between the sales and the cost of goods sold is gross profit. Gross profit is the difference between the two for the 2 years. Less administrative and lease expenses are then provided. Then accordingly, every analysis has been done, and then finally, the net asset is 11.1% in 2018, 11.1% of total sales, it means, and 12% of total sales in 2019. So this again is very much important in order to make kind of just comparison, kind of analysis of each and every component of the income statement relative to the total sale in each year, and also comparison of the figures between the 2 years. So this is very much important, just to provide sort of understanding about the business in a given year and as compared to another year. So further example could be provided here. The Proof Rock Corporation has such balance sheets in 2006 and 2007 at the end of the respective years. So based on this, we can develop the common size analysis, common size balance sheet in the same way. So this is what we can say. In 2016, we have this benchmark, which is total asset 100%. And 2007 is the same way. This is taken as benchmark. And cash is 25% of total asset in 2006 and 2.7% of which is total assets, and the difference is positive. 2.7 minus 2.5% is 0.2% increase. In the same way, account receivable is 4.9% of 100%, which is total asset in 2006, and 5.2% in 2007. Again, the difference is positive. 5.2% minus 4.9% is 0.3% positive increment. So in the same way, we compute this, and net plant and equipment is negative 0.6%, which is decrease in plant asset, which is fixed asset, is there because of maybe depreciation. In the same way, the liabilities and the shareholders' equities could be computed accordingly. Accounts payable is 9.2% of total liabilities and shareholders' equity in 2006, and 9.6% of the 100%, which is total liabilities and owners' equity, shareholders' equity. So again, the difference is positive 4.4% and so forth. Therefore, in the same way, we can just evaluate the performance of this firm taking into account the components of each major financial statement within a year, within a given year, as well as between years or among many years even, and accordingly the difference is computed. Again, we can also make analysis of common size income statement in the same way. Sales, which is total revenue, is the base and it is 100%, and every component is evaluated from this point of view. So cost of goods sold is 58.2% of total sales. Depreciation is 11.9% of total sales. The difference is 100% minus 58.2% minus 11.9% is 29.9%, which is earning before interest and the tax. Interest paid is 6.1% of the total sales. So the difference is taxable income, which is 23.8%. Tax rate is for 34%, and 34% of 23.8% is 8.1%. And this is the net income, which is 15.7% of the total sales. So, and out of this, 5.2% is paid in the form of dividend to the shareholders, and the remaining is retained for the business expansion or reinvestment purpose. So this way we can analyze the common size statements. So by the common size statement, we are able to just make the breakdown of the components of the major balance sheet or maybe income statement, and accordingly we can see the percentage or the proportion of each component as compared to the benchmark. The next one is ratio analysis. It is one way of just avoiding the problems involved in comparing companies of different sizes to calculate and compare the financial ratios. As you may know, figure is absolute figure may not be a very good way of comparing the performance of different companies, but ratio is a relative measure. Therefore, it will enable us to know the difference in the performance among the small and medium and large companies, because it is relative, it is not absolute. So accordingly, we will have different questions to be answered by the ratio analysis, or when we are going to deal with the ratio analysis. The first one is how it is computed, what is intended to be measured, and why, what is the unit of measurement. Of course, ratio is neutral, but the components of the ratio are not neutral. It could be money or birr or dollar. What made a high or low value tell us how much such values be misleading, and how could this measure be improved. So in general, we will answer these questions by using 5 different types of ratios in the organizations. The first one is short-term or solvency, which is liquidity ratio, long-term solvency or financial leverage ratio, asset management or turnover ratio, or sometimes we call it efficiency ratio. The fourth one is profitability ratio. and the fifth one is market values ratio. The first one, short-term solvency or liquidity ratio, simply measures the ability of the firm to pay its short-term liabilities using its short-term assets or current assets. So here liquidity ratios are particularly interesting to the short-term creditors, especially suppliers or maybe banks which lend for a short period of time. And so under this liquidity ratio, we have three measures. The first one is current ratio. It is simply the ratio of current assets over current liabilities. If we take the Prufrock company in the 2007, if you can refer back to these values, the current ratio is simply the current asset, which is 708 divided by current liability, which is 540, and the result is 1.31 times. This means current assets are 1.31 times the current liabilities, or in other words, the current assets cover 1.31 times the current liabilities. So at least this corporation is able to cover its current liabilities using its current assets. So to the creditor, particularly a short-term creditor such as supplier, the higher the current ratio is, the better. To the firm, a higher current ratio indicates liquidity, but it also may indicate an inefficient use of cash and other short-term assets. So it has both advantages and disadvantages. For the creditors, it could be advantageous, but if the current ratio is excessive, it means that the company is not using its resources efficiently. So usually we would expect to see a current ratio of at least 1, just to assure that the current assets are able to cover the current liabilities. And if it is less than 1, it means that the net working capital is negative, meaning the difference between current assets and current liabilities negative. It means if it is less than 1. This would be unusual in healthy firms, at least for most types of businesses. So what we can say from this is a given firm should be able to cover its current liability using current assets. This means at least the current ratios should be equal to 1. The second measure of liquidity is quick or acid test ratio. This is a more just rigorous measure of liquidity because it is more stringent. It disregards inventory from the current assets because it is most of the time believed that inventory could be damaged, could be obsolete, or could be lost, and hence not to jeopardize the position of the suppliers or short-term creditors. It is better if inventory is just excluded from the current asset. This is the contention of the quick or acid test ratio. So accordingly, quick ratio is the difference between current assets and inventory divided by the current liability. So if we take into account our example of a Prufrock Corporation, the current assets are 708, and out of this 422 is of inventories value, and when we divide it to the current liability, it is about 0.53%. It means nearly the most liquid assets can cover about 50% of the total liabilities. So of course this could be said, and in the same way, the higher the quick ratio, the better for the suppliers or for the short-term creditors. The third measure of liquidity is cash ratio. This is a very short-term credit or the most liquid asset to the current liability, and it is a very short-term creditor. A very short-term creditor may be interested in this type of ratio. So you can verify that this works out to be 0.18 times for ProofRock. You can go back and refer to the balance sheet of the ProofRock. It is the ratio is simply the cash divided by current liabilities. The next one is long-term solvency. So in the next video we shall start our discussion from this second type of ratio analysis. So thank you very much for this discussion.